starting more of a train the trainer program this year, as you all know. So we're going to go more in depth to all of the issues that a business owner might face, that an aspiring entrepreneur might face as they're thinking about taking over an existing business, and trying to give you more tools and develop together more tools and resources that will make it easier for you to help businesses in your own communities. So we've been funded traditionally through the Northern Border Regional Commission since we founded this program, but the grant for this year is through the USDA RCDI program, and it really is focused on this training. So every month from here on out, we'll do some regular CBIT liaison partnership kind of meeting stuff, and then some really in-depth training and getting into the weeds. I'd like to introduce Kim Mannion. She's our small business specialist at the Adirondack North Country Association. She's going to be delivering all of this training. She's owned her own business. She's transitioned her own business. She's worked for the SBDC. She's bought a business. Like, she's done all of it. And she's just been working with all her clients as just a rock star. So she's going to take us through this training month by month, little by little, and make sure that we all really get what we need to be able to be successful in helping businesses. And I look forward to learning more myself. So Kim, take it away.
Will do, Danny. Thank you for that quite an introduction. Hopefully I can live up to all of that. I want to welcome everybody. I'm thrilled that we have so many economic developers interested in what we're doing here. As you all know, the work that we do with helping small business owners sell their business is super important to the economic kind of prosperity of our region, because if those sellers aren't able to transition their business, we lose those jobs, and we just don't want to do that. And a couple of comments have been made this morning and now about the sensitivity, and the intimacy is a little bit too strong a word, but these business owners are embarking on a journey that's foreign to them, and it's opening their books. And if they can do that with someone that is close to them, which you all are, like we here in the Center for Pandemic or CBIT are perhaps an arm's length from them. So for you to understand this process and to be able to kind of quote unquote hold their hand through this process, it just makes it that much more likely to be successful. And I encourage you to ask questions as we go through this, because it just makes it much more impactful and that kind of thing. And I'll get to how we can do that. I don't think we need to do introductions because we had such an awesome icebreaker earlier, and that was phenomenal. I have to remember that. So a couple of housekeeping things. We're going to do some polls along the way. It's just kind of a fun way to interact with you folks in a virtual environment, kind of get you thinking and makes it interesting. Please ask questions. And I promise you, like, if it is a question that you have, it's likely that it is a question that a lot of people have. You can do it via chat. And I know that there are probably folks there's a continuum of awareness and knowledge of Zoom. There is a way to ask questions, and I'll show you in a moment, where you can ask Zach or Danny a question and you don't have to post it to the whole group. So if you have a question that you're maybe not so comfortable to ask openly, you can do it that way. We're going to take about a 5-minute break halfway through. And it's at that point that we'll make a decision about the content that we want to cover afterwards. I kind of like, it's those like interactive things where you get to decide the outcome of a book or show or whatever. Keep your video on if you can. I think it's nicer for everybody, but that's entirely up to you, really. We will have a quick quiz at the end, and that is more just all the polls and quizzes are anonymous, and it's more just to help me get a gauge on kind of our understanding of the material and maybe what we need to review in our next session. So this is, I think I need to right click here and go to my pointer and go to, oops. So right here in the chat box there's a drop-down box where you can send a message to a specific individual. And most people probably know this, but just in case there are those that don't, and that's a way to ask a question kind of privately that Zach can or Danny can bring to all of us. All right. So this is the big picture of our 9 months together. Our first 3 sessions, we're going to go through as if you are business owners. The next 3 sessions are where you'll get a better kind of your arms around the content. And then our third 3 sessions, we're going to be delivering the content. So for some reason, my down arrow's not working. Today, we'll talk about the big picture and an introduction to the selling process, and we'll talk about valuation. And then at the break, as I mentioned, we'll make a decision around continuing around valuation, if that's the direction we want to go, or going into sell sheets. And valuation and sell sheets are 2 kind of big things that a small business owner needs in order to be able to go to market. And then session 3, we'll do, what do I do when I have a serious buyer interested? And as I said, we're going to flex those. The next 3 sessions are what we learned from our current liaisons is that they would like to have a 1-hour session that they can provide one-on-one or in a group setting, virtually, in person, but that provides a seller with an overview of the whole process to kind of get them going and get them the information that they need so that they can start to ask intelligent questions of the team of people that they will have around them. So that's what we will do there. And then we'll dig into this, the content around valuation prep and sell sheets. The valuation I will go through with you because you're going through as a seller in quite detail. It's a little bit too much to ask of you to do the valuations, but what you can do is do the prep around the valuation with your clients, the sellers, and then I would work with you to get you the valuation done. Then the sell sheets, and then these ideas around how you market your business, legal considerations, financing options, that kind of thing. And in our last 3 sessions together, you'll be presenting the content, and we'll go into breakout rooms and you'll present to one another and ask questions and that kind of thing. And then we'll bring in some subject matter experts around things like perhaps employee cooperatives or transitioning to a family member, perhaps a legal expert or an accountant and that kind of thing, to just give you a really well-rounded and a really solid foundation around this process of enabling business owners to transition their business. So we will be offering a certificate of completion for those participants that participate in 7 of 9 sessions live. And then you'll need to review any of the missed sessions, and that's an honor system. Then we'll have you pass, and I kind of use the term loosely because I have every confidence that you guys will understand this content and be able to deliver it. And then those that complete those steps and receive the certificate of completion, we will feature you in a media campaign, including our ANCA newsletter, our ANCA and CBIT social media outlets, and other things. So there's an incentive to complete our program together. So hopefully you saw in the email, and you may not have, which is fine, but as I mentioned, in our first sessions, I'm going to put you through the training as if you are a small business owner. Zach sent out 4 business profiles that included a couple of years worth of P&Ls and a little profile and some notes around the financials that we'll include. And then there was an article from Forbes. I think one of the things that will make you successful is not just the fact that you are close with your constituents, but also kind of having gone through and hopefully having a little bit of empathy around what it's like to be a small business owner. And I believe that many of you actually have been small business owners. So hopefully you take a look at those profiles. Hopefully you've adopted one. There was accounting, sports, plumbing, and gosh, I wrote these and I can't even come up with the last one, but hopefully you picked one. Or I suggested that if you had a small business, you could look at what it would be like to sell that, or you could create your own. So welcome, small business owners. I want to thank you for joining us today. Planning for the sale of your business is super important. The process can take from 3 to 5 years, depending upon different circumstances that are, involved. You are masters in your craft. Many of you have spent years and decades building your business to be the success that it is today, and it can be all-consuming. And the process of selling your business is uncharted waters. Most of you have never gone down that path, and so it's a little daunting to think about tackling that. And we are going to walk you through step by step the process of selling your business and give you the context. So we'll talk about the team that you're going to build to help you sell your business. You can engage with them in a meaningful way and ask them intelligent questions and hopefully avoid some missteps that sellers sometimes go through when they are selling their business. And I can't emphasize enough, please ask questions, because it really, as I said, chances are other people have the same questions. Quickly, normally we would do an intro to the Center for the Businesses and Transitions. We don't need to do that today. We'll talk about getting your business ready. Some of you may be ready to go to market today. Others, it may be a 3 to 5 year journey before you even think about that. And we'll just spend a little bit of time going through what's the steps that you can take today to get ready to sell your business. We'll give you the big picture of the selling process, and we'll go through that. We'll talk about building your team, the people that will support you in this journey, whether or not you want to go to market openly or anonymously. Some of the timing considerations that can speed up or slow down the process of selling your business. We'll introduce this concept of valuation and how you assign or create a value for your business, because I know most of you don't have an understanding of what your business might be worth or how to go about doing that. We'll talk about goodwill and valuing goodwill and this concept of sellers' discretionary earnings. And then we'll go into whether we want to continue down the path of calculating sellers' discretionary earnings, and this is a democracy and we're going to take a vote, or whether we want to kind of deviate from numbers for a bit and come back to that in our next session and perhaps talk about creating a sell sheet for your business, which is basically a resume for your business. We're going to have that quick quiz at the end, and then we'll talk about closing and next steps. So a number of businesses, one of the reasons that they struggle with going to market is they don't want anybody to know that they are considering selling their business. And all of you are here today, which means that at some point you're interested in selling your business, but please respect that people may not want to know that. And we haven't signed non-disclosures, that's the NDA, a non-disclosure agreement, but please, any conversations and such that go on, we ask that you maintain that confidentiality. All right, so our opening poll today, I'm going to launch this poll. Hopefully you all can see it. And our questions are the top reasons why businesses don't sell, or the top reason, a lack of buyer preparation, sellers' unrealistic expectations around price, poor seller preparation, personality conflicts, unreasonable non-financial demands on the part of the seller. And you can go through and answer these. Then my top priority, they're around priorities, and then your level of comfort with Excel. Hopefully people can see these polls. Cool, we're starting to see some responses coming in. Okay, why don't we give it 30 more seconds? We're at, this is awesome. Alrighty, we are going to end the poll. We're going to share the results. Hopefully you folks can see it. Whoop, where's my poll? Okay, so the top reason why small businesses don't sell, and this is something we'll cover in our content, but lack of buyer preparation, sellers' unrealistic expectations on price, 54, poor seller preparation, 42%. Well, those are great answers, and we'll talk about that. I was very happy to see that as sellers, you want to find the right buyer who will take good care of your employees and customers. That's great. And some people want the highest price. I certainly respect that, because for some business owners, it's their retirement, right? It's not uncommon for a business owner to have put the majority of their available funds back into their business, and they haven't tucked a lot aside for retirement. And then I'm happy to see that that you guys are comfortable with Excel. That is great news. All right. So let's start with a few facts. So beating the odds together. It's commonly known that only 20% of businesses actually sell. That's the bad news. The good news is that with knowledge, you can control, or at least help control, a lot of the reasons why. So let's take a look at the 5 common reasons why businesses don't sell. And this is through, I think it's a Pepperdine study. The number one reason is unrealistic expectations on the part of the seller around price. And professionals in the industry say it can be high as 50%. A seller will be told that they can sell their business for X, and it doesn't work. And we will go through a process of valuing the business, and then we will, what I call, validate the valuation and make sure that the price works for both the seller as well as the buyer. And we'll go through that in detail. Lack of buyer preparation. While you're not the buyer, by going through this course, you're becoming knowledgeable about a lot of the aspects and perspectives of the buyer, and you can help guide them through that. So you can tackle that. Poor seller preparation, obviously you're here, so you're tackling that. And then these additional, and they don't add to 100 because there were some others that were less, that weren't even shared. 59, you can control 59%, and that's a great thing. Let me just take a look at the chat. Lack of buyers. Sorry, Russ, I'm going to ask you to chime in. I am not. Oh, just the lack of buyers ready and available to buy the business, for sure. It is. Yeah, and sometimes there's actually a disconnect between the sellers and the buyers, and the buyers that are out there aren't aware of the businesses that are available to sell. So yeah, for sure. Thank you, Russ. Oh, okay. Preparing to sell. Keeping meticulous records, financial records. That kind of goes without saying. If you're the kind of business that tends to throw your receipts in a shoebox and hand them to your accountant, you need to clean that up. Increase your profitability. I know that's easier said than done, but we'll talk about sellers' discretionary earnings and how it affects valuation. If you own your business, and as a business owner, it's your kind of privilege. It's not easy owning a small business, but you can run things through your business legitimately, right? They might not be critical to the operation of the business, but you can run your automobile gas and that kind of things through. As you get ready to sell, you may want to clean that up, either document it very, very clearly or get rid of it altogether, because your profitability not only affects the valuation of the business, but it definitely affects your financing options if you want to go through a traditional lender. Document your processes, like depending upon your kind of business, spruce things up goes without saying. Train your management, go on vacation. You want to have a team of employees in place that can run your business without you, right? So that when a new owner comes along, they have a team of people that can help get them up to speed, as well as you're helping to get them up to speed. And consider a business plan. We'll talk about the sell sheet, which you use to market your business. But in order to secure traditional financing, you do need a business plan. And that can be a big hurdle that I'll discuss a little bit in terms of a buyer. And you know your business, and you could help craft with that. So here is the selling process. These steps may not occur exactly in this order. They may occur simultaneously, but this is just an overview. One of the first things that you're going to want to do is put a team together. As I mentioned, these are the individuals that are going to support you through this journey and provide you with really excellent advice about how to proceed. You're going to make a decision around whether you want to go to market anonymously or full disclosure, like full court press, everybody knows. You're going to establish a value for your business and the various components of your business. You're going to create a sell sheet, which is a resume for your business. It's a tight and concise marketing piece that will be the foundation of your marketing effort to market your business. And then you're going to market your business through various means and avenues. An interested buyer will come along, and you're going to want to vet that buyer out of the gate. You don't want to waste your time with tire kickers that aren't legitimate, strong buyers that are not just interested in your business, but that have the capability, the financial resources, and that kind of thing to buy your business. And you want to start that process as soon as possible. There's not the non-disclosure agreement, and it will be a mutual non-disclosure agreement, because not only are they asking you to open up your books to them, you're going to ask them to open up their financial books to you. You're going to get a personal financial statement, a credit report, etc., because it's a vetting both ways. The initial evaluation is kind of the dive into the P&Ls, the superficial information that will help you make a determination around whether or not you want to move forward with the business. Then there will be an offer, hopefully, that is made, and it's generally done through a document called a letter of intent. And that's where the negotiation often starts. Sometimes there's negotiation that goes on ahead of that, but very often that is where the negotiation starts. With the letter of intent, there is, I think I forgot my little dollar sign, often what is called earnest money. And that is essentially a deposit that is offered. And it means that you go into a period of exclusivity where you as a seller agree to not engage with any more buyers while this current interested buyer goes through a process of due diligence and takes a deep dive into your business to learn everything about it to decide if in fact they do want to proceed. It's at this time, or perhaps before, that in parallel, the buyer will be pursuing financing options to be able to make the purchase. though it will lead to a contract. That contract may have some contingencies. And finally, you'll have the execution of the purchase and sale agreement, and you'll have sold your business. So that is the big picture. Throughout our 9 months together, we will dig into these various pieces and get you up to speed so that you can share this content with prospective sellers. Timing considerations. As we said, the process can take from 3 to 5 years, sometimes shorter, sometimes longer, but there are things that you can do to speed up and slow down the process. So identifying a seller is, I'm sorry, a buyer, as Russ mentioned, it can be challenging. There just aren't a lot of buyers out there. And maybe there are, but it's connecting with those buyers. And it's even harder if you're going to market anonymously. And we'll talk about the choice between whether to go to market full disclosure or anonymous. Anonymously will take longer. And is your business priced fairly? Is it a price that works for the seller as well as the buyer? The due diligence, you want that due diligence period to be time bound because it can go on forever. And you as a seller want a very tight time frame for that due diligence to happen. The buyer wants it to be as wide open as possible. So making it time bound can move that along. And then the financing. And we'll talk about seller financing, and that can certainly speed things along from moving the sale along. Great, let's dig in on some of these different processes a little bit more. We're going to talk about building your team. Who do you think would be the first professional you would want to contact if you're thinking about selling your business? And just think about that for a moment. Your team. As I've said, you're going to build a team of individuals that will help you get this right and help you avoid some missteps. You want to maximize your profits, even if that's not your top priority. You want to make as much money as you can selling your business, right? Taking other priorities into consideration. You want to minimize your tax liabilities, so engaging with a CPA is certainly important. You want to minimize the selling time, because if you've made the decision that you want to sell your business, you're probably ready to move along. This is a list of individuals that you may or may not want to include. Some you will need to spend money on for sure. Other people like CBIT and the SBDC has been brought up a couple of times. They can help you. Free. Am I having a hard time here? All right, your accountant. This is an individual that you cannot do without. It's probably the first individual that you would want to reach out to if you are interested in selling your business. They can help you understand valuation. We can help you, but there are very entity specific valuation questions that are above my pay grade. And your CPA will be able to help answer those questions. If you don't have confidence that your accountant has experience with business transitions, just feel them out on that, because some don't. They would be available to help you with negotiation, and they're definitely worth the amount of money that you're going to spend with them. An attorney is another one. Don't go to novo.com or Nolo or whatever this is something that you, without question, need an attorney. The devil's in the details. Again, you want somebody that is an expert in business transition. And this is likely where the bulk of, there will be expenses that you will have in selling your business. And my experience in both buying and selling, this was the single largest ticket. When I bought my business, it was a stock sale, and my legal bill was about $10,000. When I sold, it was an asset sale, and it was about $4,500. So just some examples. My advice around this is make sure, I don't know that legal most stuff is a technical term, but some attorneys want to be involved at kind of every step along the way. They'll want to negotiate on your behalf. They'll want to, and you're paying them 300, give or take 400, whatever, dollars an hour. And that adds up really, really quickly. So my advice is figure the conceptual stuff out, engage with your attorney when just on the legal stuff. Many of you may have debt associated with your business. Sometimes it'll be transferable, sometimes it won't. You need to sort that out. You also want to understand if it is a loan that needs to be paid off at the close, when you close on the sale of your business, you need to understand what that amount is and try to tackle that sooner rather than later, because sometimes it's a bit of a process to understand what that number is. And so don't drag your feet. You may want to engage with a broker, and we'll talk about this more in a bit. It's money. It's certainly like selling your house. You have to pay a fee, but it may be worth the money, and we'll talk about that a little bit. A realtor, if there are, and there are many out there, I know we have Christy on the line, realtors that are versed in selling real estate with a business associated with it. Not every realtor is. And so certainly engage with a realtor if you have confidence that that individual can help you, and if there's a lot of real estate associated with your business. And Christy, if you have anything you want to add, certainly jump in there. Appraisers, often with real estate, if you have high value components that are part of your furniture, fixtures, and equipment, that is all of the stuff that you use through the course of running your business, you may need to get an outside person to provide an appraisal for that. Your financial planner may help you understand how much you need for retirement, and that needs to go into the mix in terms of determining the value of your business. And I have the roller coaster here because having gone through buying and then selling a business, it is a roller coaster ride, and having a good support network of people that can help you navigate that is super important. So a decision around, listen, folks, I have no questions. I need questions. All right, well, please, I can't imagine. Trust me, like when I listen to myself sometimes, when I go back through my recordings, I kind of blather on and I can't even follow myself. So I have to believe that you guys have questions. So please don't be afraid to ask, especially now that we're going to get into valuation and such. But anyway, I digress. So the decision around whether to go to market confidentially, anonymously, or full disclosure is definitely not a decision that you want to take lightly. If your customers, your suppliers, employees find out that you are trying to sell your business, who knows how they could react. And you need to balance that with the obvious benefit of going to market full disclosure, because clearly it's easier to market your business if you can let the world know that your business is for sale. For certain kinds of businesses that are probably best kept under wraps in terms of selling, if you have a business where you have a few high value customers that are the bulk of your revenue, that's tricky. If the owner is perceived as being critical to the business, right, that they have a technical expertise that will be a process to transfer to another owner, and then this kind of concept around sensitive kinds of proprietary information. And if it's important to you that you go to market confidentially, consider a broker for sure. There are certainly pros and cons to engaging with a broker. The analogy that I use sometimes is, would you try to sell your house on your own? Probably not. There are people that do, but most people engage with a realtor or broker. So you would think it's a slam dunk or a no-brainer to engage with a business broker, but it's not quite as straightforward as that. There is no question that a broker is knowledgeable about the process. They can help you navigate the process. They can vet buyers so you don't waste your time with buyers that aren't capable or aren't truly serious about buying your business. They've negotiated a number of deals. They can help you negotiate the process and the deal. They can be the voice of reason during the negotiations, and they can let you focus on running your business. The flip side is they can be expensive. Like 8%, 15%, it's a big number, and it depends upon the complexity of the deal and that kind of thing. Sometimes there's money up front that's requested to like a retainer to do marketing and that kind of thing, and then there's a back end. But they may earn that money. The hardest part is it's very often difficult to find business brokers that are willing to work with small businesses. There's certainly plenty of brokers that are willing to work with businesses that have multiple millions in revenue and or profit, but that's not us. That we are small businesses, and then finding somebody that's going to be able to do a really good job for you is hard. And they will often ask for a commitment. And that means that even if you identify a buyer similar to a home, you would still need to engage with them. If you want to go it alone and you want to maintain your anonymity, set up a separate email account, right? So that it's obviously hidden. Consider a separate phone number, no meetings on site. Like these are fairly straightforward. With regards to the sell sheet, there may be, if you are the only, let's just say, Vietnamese restaurant in Ogdensburg, you probably need to be a little bit more broad in saying, you could say restaurant in, I hate doing it, I don't know what county Ogdensburg is, but you get my point. So just again, my personal experience, when I bought my business, it was 100% confidential. Even when it is confidential, like kind of word gets out, I obviously knew that the business was for sale. The seller was adamant about maintaining confidentiality. I mean, adamant. And the employees knew nothing until after we closed and we walked in. Now, I contrast that when I sold my business, I was full disclosure. I sent letters to my competitors. I did Facebook boosts. I sent information out to my email list. I kind of did everything. So just two approaches. So around your decision, consider your priorities with regards to that, and consider how letting the world know that you're interested in selling could affect your business. And perhaps consider starting out confidentially and then seeing how that goes. And if you don't feel like you're getting traction, then and you make decisions around your priorities, you then go to the next level. All righty. Now we are going to talk about valuation. I'm going to take a drink here because I'm doing all the talking. And happy to. All righty. So as I said, most small business owners have no idea what their business is worth. And we use kind of a common sense approach called to valuation called rule of thumb valuation. And we'll dig in on that. Valuation is your company's total worth. There are several components that you need to establish a value for. And it can be a pretty complicated process, but we're going to break it down step by step and help you understand the value of your business. And it's super important, in my opinion, that you as the seller understand the value of your business so that when a buyer comes along and they say, gosh, how did you establish, $500,000 or 50,000 or 5,000 for your business? How did you get to that number? And you can then sit down with buyer and walk them through how you establish that value. There are a lot of very complicated ways to do, and there are like several year courses around how to value a business, and they can cost lots of money. And there are instances where you need a valuation that's done by a CPA or a certified valuation expert. The value that, and this is kind of, some instances are where if you're transitioning to an employee stock ownership program, if you're like gifting your business to your kids over several years and they need like the IRS needs a particular number, those valuations do cost thousands of dollars. Our approach is just a common sense approach, using some numbers that we'll talk about, and kind of this fair market value concept. It's a number that works for the seller. I love this quote. Asking price is what the seller wants, selling price is what the seller receives. Fair market value is the highest price the buyer is willing to pay and the lowest price the seller is willing to accept. Right? Like that's in it in a nutshell. And that's the concept that we are going to base how we do our valuation on. And again, you're establishing a price that makes sense from both a supply and a demand perspective. And any economic people out there will appreciate that graph. It's a number that works for you as the seller and the buyer. And the key concept with the number working for the buyer is this idea that, and because of time limitations, we don't dig deep into some of the demographics around buyers. And if it's something that people would like to, we can, but a vast majority of buyers earn less than like 50 or 60,000. These are folks that have been squirreling away money over the years in the hopes of establishing a down payment, right? They don't have hundreds of thousands of dollars sitting there. So they will bring their down payment to the table. They'll need loans in order to buy the business, and those loans need to get paid back. So we will make some assumptions around a down payment at about 20% and debt service. And the price that they pay for your business needs to support that debt service and then leave enough left for the buyer while they're paying the loans down that they're comfortable with. And it could, if it's a small business, it's a supplemental amount, it may be just a couple $1,000s. But if it's a full-time business where an owner is working full-time, they need to be able to pay themselves a reasonable amount. And then the hope is that they can actually invest in the future of the business. So we'll dig in on that. There are several components that need to be valued. We have goodwill, inventory, furniture, fixtures, and equipment, this kind of catch-all of other, which leads to the price. Goodwill is the non-tangible component to a business that has been around for a while. It's why people often buy businesses and don't start businesses. Inventory is the stuff that you have for sale. It's what you sell. And a service business isn't going to have a lot of inventory, but a retail business will have quite a bit of inventory, and you need to assign a value for that. The furniture, fixtures, and equipment is the stuff you use through the course of running your business day to day. And again, there are some businesses that will have very little FF&E, and there are heavy equipment type businesses where the FF&E is a huge number, and assigning a value to that is important. And then maybe you have a website, maybe you developed an app, maybe there are contracts, licenses, permits. That's that kind of catch-all other that also needs to have a value assigned. And when we'll establish values for each of those components, and then that will lead us to a range on the price, which we then go through and validate that kind of range. As I said, it's an art versus a science. The how we'll determine the value is the business trajectory increasing revenue, increasing profitability, and then the validating. But again, this concept that if the price is too high, it's just not going to sell. And beyond the fact that it's not going to sell, and you as economic developers, sorry, I'm adjusting that in, you understand how difficult it is to get financing. And if the price of the business is too high, nobody will fund it. And so understanding and reasoning with sellers is super critical. So goodwill. Oh, sorry. And then there is the component of real estate. Some of you may own your real estate, others may rent, and you need to make some choices around your priorities. Are you willing to sell the business only and maintain ownership of the real estate? Is it a one, together only? I'm not selling the business without the real estate. Regardless, we need a valuation for everything and then a separate valuation for the real estate. And when we go through the process of valuing the business, we make some assumptions around any rent that would be paid if you were to sell the business and not the real estate. All righty. So intro to valuing goodwill. All right, here's another poll. Okie doke. Oh, no, that's not the poll, that's chat. Here's the poll. So what is goodwill? Righty. So I just launched our second poll. Goodwill is, and you guys can read through the choices. Okay, 16. To 10 more seconds. All righty. We're going to share the results. So 18 of 23 said all of the above, and it is all of the above. Goodwill is that kind of je ne sais quoi about your business. It's how profitable you've been able to run your business over the years. It's how long you've been in business. It is the value of your customer base. It's the brands and the maybe you have exclusivity as I was a retailer and I had brands that they wouldn't give to anybody else because I was that dealer. So that's it's the revenue, it is all of the above. So nice job. So goodwill, here we go. So it is, we just talked about that.
Hello, Kim.
Yeah.
I just want to let everyone in the chat know that they are messaging the wrong Kim, and I cannot help them with anything that they're asking me.
Sorry, I am Adirondack North Country. You know what I'm going to do? Thank you so much. I'm going to change. How do I change mine? Oh, rename. I'm going to make myself here Kim. Hold on. Kim at Anka. All right, Kim, how would you like to read off those questions?
No, thank you. Go ahead. Let's see. I have one that says, how does one value the non-tangible values?
Okay, awesome question. That is exactly what we're going into.
And then somebody said, accounts payable and receivable, question mark.
Yep, we'll talk about those. Because accounts payable are liabilities that would go kind of take away from the value of the business. The expectation is that you would likely close those out and pay those off before you were to close on the business. So we would take that into consideration on a case-by-case basis.
Those are the only two that I got before I stopped you.
Cool, thank you, appreciate it.
No worries.
I'm going to also flag that Danny will be in and out and stepped away for the moment. So if you're sending questions to Danny, send them to me, Zach. Thanks.
Perfect. Thank you. Okay, awesome. So value and goodwill, it is the hardest part because there's nothing there, right? There's nothing physical to assign a value to, but it is very doable, and we're going to walk you through step by step on how you do it. And you know, the vast majority of you said that you are comfortable with spreadsheets, which is awesome, because through the course of our time together, we will establish a value for your business, and we will enable you to understand it and explain it. So with rule of thumb, we're going to use numbers that everybody can understand and that you will be able to understand. So top line revenue, and then this concept of seller's discretionary earnings. And then we use a multiplier that we'll talk about. And we'll talk about the SBDC, and if you don't have your multiplier, you can get one from the SBDC. They're awesome. Okay, seller's discretionary earnings. And it is the way that we establish a value for goodwill, that intangible component of your business. It's seen as the most relevant and accurate way to value what 98% of the businesses that we will deal with, that I deal with, Main Street type businesses, they're lifestyle businesses, mom and pop businesses. These are owner operated businesses that are not the type of businesses that an equity fund would want to invest in for a return, right? These are owner operated businesses. And as I said, it's the best way to assign a value. So what are sellers' discretionary earnings? And I have no idea why some of these float in and some of them don't float in. I think I was pulling slides from different things. So sorry, just kind of gets keeping interesting. But what seller's discretionary earnings is it's an estimate of the total financial benefit that the new owner would expect the business to generate for them. So it's the total benefit to either the seller, right? But we want to be able to assign it for the owner as well. And they're kind of synonymous. It's known as a whole lot of different things. It's seller's discretionary cash flow, adjusted cash flow, owner's benefit is definitely recasted earnings and normalized earnings. And we will go through and normalize the earnings for your business. And the way that we do that is, as I mentioned, you as a business owner run things through your business that are not critical to the operation of the business. Perhaps your health insurance, perhaps your life insurance. I ran all of my gas through my business. And I mean, I went to the bank. Occasionally I brought bikes to and from customers, but certainly not 100%, but that's an example. And we will go through line by line and understand what expenses of your business are critical to the operation of your business. And if you didn't spend them, it would affect your business versus those things that you're running through at your discretion and things that are one-time in nature. And we'll go through those. So let's take a look here. So here's just kind of a pretty quick and dirty P&L. And you know, 225,000 in revenue. We have our cost of goods sold leads to a gross margin of 100,000. Different expenses that we have gets us to a net profit of 57,300. I'm not sure that I made this point. It is cash flow. Cash is king. And so that is another way to look at it, is it's the cash flow that the business would create for the new owner. So one of the first things that we need to do is go from the profit and loss to the cash flow. And what does that mean? So depreciation is not cash-based, right? On a P&L, that's just kind of an accountant's, like you actually paid for the thing a long time ago, but it's the depreciation. So we have to back that out. So that increases our cash flow to 60,500. So now we want to go from the cash flow to the seller's discretionary earnings. So we want to add back the discretionary and one-time expenses. So, for example, your automobile expense is $2,400. And let's say $100 a month of that is, real and running your business and you need to use your car. And $100 a month is really personal in nature. So that means the business expense really is only $1,200. Similarly, you may run your life insurance through your business, and that's $1,000 a year. So we back that $1,000 out, which means the real business expense is $4,500. I ran my Y membership. I owned a sports store, right? Like, it was important that I was fit. So my Y membership, I ran through my business. That was $600. So $2,200 minus $600 is $1,600. So that might be, my membership in like realtor.com or, whatever. So some examples of these adjustments that we'll make. Then these one-time expenses. It could be a repair. In this instance, example, it was a $2,000 website that was built. That's a one-time expense, not expected. It's not the maintenance for the site. It's not the hosting. It's the creation of the site that was a one-time. We had backed that 2,000 out from 10,000, we get to the 8,000. So here are our adjustments that we made in red, and you can see how they increased and made the seller's discretionary earnings $65,300. And one thing we don't talk about in here that I will is the owner's pay, and that gets added back as well if it is included in the P&L. Waiting for questions. Okay. As it's a really strong indicator of the value of the business. It's important that you understand. We're going to go through, and I will spend time with you helping you go through your P&L line by line. Okay, we're going to take a 5-minute break. And I know that we've spent quite a bit of time around valuation. We can either dig further into valuation, or we can come back to valuation in our next session if you've had enough numbers for one afternoon, and we can go into sell sheets. So we are a democracy here, and we are going to launch our poll around what content we would like to cover after the break, and I will adjust accordingly. Well, if it's a tie, who gets the deciding vote? That's the big question. I'll ask you, Zach.
Now, whichever one you think is more fun.
That's a tough one. All right. Why don't we give it like 10 more seconds? Let your voice be heard. I think people have stepped away. We have 20 of the 28, so we're going to end the poll, and the winner is seller's discretionary earnings. I have to tell you, I am a spreadsheet nerd, not going to lie, and I think maybe we have a couple of spreadsheet nerds out there too that enjoy kind of digging into the numbers. So sorry for those that were interested in the sell sheet. We will absolutely cover that in our next session, but here, we're going to continue to talk about the seller's discretionary earnings adjustments and some of the common categories that are where these adjustments are made are, as I mentioned, auto expense, kind of life, health, your personal auto insurance might be run through your business, some dues and subscriptions. You can read, I don't need to read this off to you, but these are some of the categories. Like, you might own where your business exists, and the guy comes and plows your house too, right? And it all just kind of gets wrapped in the bill that's sent to your business. Every time you go out for dinner, you may talk business, right? and you run it through your business when in fact that those aren't really necessary. So one of the ones that that we need to talk about is rent. So if you own the building that your business is in, you may be paying yourself above market rent or under market rent. And in order to value the business, we need to establish kind of a market rate for rent. And we need to make some adjustments up and down. And I think this next slide, yeah, this was kind of my situation. I owned the building that my business was in. A different company owned and still owns the building. And my business paid the real estate holding company $4,000 a month in rent. That was about $1,000 a month above what market rent would be for that type of space. But as a business owner, you know, like if you're paying yourself rent, you avoid that, some of the payroll taxes, which is why people do this. But the true business expense is then $36,000. So an example. Or I had a client who was paying under market rent because the cash flow of the business didn't support what rent should have been charged until a certain point, and then they were able to increase it. But there are adjustments that are made up and down. So owners, and again, I understand that these are some concepts that we'll go through kind of time and time again, but I have a number of businesses where there are two partners, and we're going to assume that one person is going to buy the business. And in order to value the business, we're going to assume the cash flow for the new owner regardless. So we add back for that first owner, and then we make an adjustment because let's say there are two partners, both making $50,000, but one of the partners can be replaced at $35,000. So the true business expense is $35,000. So let's take a look at how we would do this. So owner's compensation. Owner number one is making 50 grand. The add back is 50,000 because we, again, want to understand the true cash flow for the new owner. But the second owner, based on what they do and the market rate to replace them, is only 35,000. So we make that $15,000 adjustment to reflect the fact that the true business cost is only 35,000. So two owners both making 50,000. You replace the one at the full 50,000. Okay, but we have to replace the second owner. It's only 35 grand to hire somebody to replacement. So we get to add 15,000 to the seller's discretionary earnings. And I will go through these line by line with you on those P&Ls. Oh, and I mentioned too, sometimes your business may employ, I don't know, your nephew, and you're paying your nephew above market rate because you're generous and whatever. And so that would be another adjustment. Like for the new business owner, I don't know, may hire your nephew, but only pay him at market rate, may fire your nephew. But again, in terms of valuing the business, we want to understand the true cost to the business. There are also these concepts of these kind of non-recurring one-time expenses. So we mentioned the development of a website. Maybe you had some legal problem and you had to pay a $5,000 legal fee, right? You're going to hope that that's not going to happen again. Maybe you developed an app, maybe you had a huge repair. These are examples of one-time expenses that aren't expected to continue, and we can add those back in. Similarly, there may be an instance where you had a van, right? And the van was at end of life. You were able to, for your business, right? But it could be valuable to somebody else and you sell it for $7 grand, right? That's a one-time expense that that doesn't get included in the valuation. Some examples of these add backs that don't really qualify is adding back all of your vehicle expense when you do in fact have people that do deliveries, or you have vehicles that are used by employees. Similar like travel, when in fact you do have to travel to go to industry meetings or other types of meetings. Adding back all your meals and entertainment when in fact entertaining clients on a regular basis is critical to running your business. Similarly, God, and anybody that's owned a business, and I'm sure you guys, we even talked about this earlier, like the challenges of marketing, right? And making decisions around how to spend your marketing dollars. And it didn't work and I would never do it again. That's just part of running your business. You can read through the rest of these, but just examples of add backs that don't qualify that you would need to keep on the books. And we talked about the importance. So we're going to use a spreadsheet, and I think, yeah. So let me quick get out of stop sharing and let me go to share. Whoops. And we're going to go here. So here is our spreadsheet. And I was happy to hear that most of you are comfortable with spreadsheets. These expense categories are like largely taken out of QuickBooks. And there you can obviously adjust these. You can, like up here, you can say, you know, I don't call it advertising, I call it promotion, whatever. You know, you can adjust these. I have dealt with clients that have like 100 lines on their P&L, right? And I go down here and I keep adding in expense categories. So this spreadsheet is pretty flexible that way. So here's the expense that's on the P&L, right? I literally, and it's very common that I literally sit down in an environment like this and a client has, okay, I'm going into economic development mode. A client has their P&L and they just start reading the P&L off to me and I enter these figures into the spreadsheet. And we talk about each line item. Is there a component that is an owner's benefit? So I'm going back in. So we go in like an auto. As I said, let's say $2,400 is what you have on your P&L. And as we said, about 1,200, I can't type now. 1,200 of that is personal in nature, right? It's not the true. So then we get to the true business expense of $1,200. You know, bank fees, and I made some notes here about kind of common expense categories that may have an owner's discretionary piece to it. Donations are made at your discretion very often. And you would make a decision about how critical those donations are to the functioning of your business. Computers and internet. I patched into my point of sale system. I had the ability to patch into my point of sale system from home. So I ran all of my home internet through my business, right? Like it wasn't really all, maybe like 20, 20% would be a reasonable amount. So that would be like another one. Let's say it was $2,000 and let's say, you know, $120, $10 a month was legit, right? Another example. This was another example. I think we said 2,200 on dues and subscription, 600 of that's my Y membership, $50 a month times 12 months, not really critical to the running of the business. Legal and professional, very often a business owner will pay their accountant to run to do their end of year business tax filing as well as their personal tax filing, and they get a single bill and the business pays it. I had clients that put hundreds of dollars of Amazon purchases in their office expense. That would be one that you would want to add back. And this is where we kind of get into the payroll and owners, and it gets a little bit tricky. So that's where we'll work together to make some of those calculations, because we need to make the adjustments and include taxes and that kind of thing. Phone, a lot of people run their entire family's cell phone through the business. You know, maybe this is $5,000 a year and, you know, 2,400 of that is their family, right? So again, this going through each line by line and making these adjustments. In order to get a truly meaningful number, we need, and I used to say 3 years. COVID has kind of obviously raised havoc with business. And some businesses are thriving as a result of COVID, and some businesses are struggling as a result of COVID. So very often I will include, it's important that a buyer see the numbers for COVID, and we can make a decision together what numbers we want to use for the valuation. Again, it's important that a buyer see them, but I generally don't include them if they are an anomaly. Like if they're going up, 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 that's not real. I don't think it's sustainable. Maybe it is, maybe it isn't. And that gets into the validation part, but that's where we're at with that. And just so that we kind of continue further, this tab or spreadsheet then populates this tab or spreadsheet, and will input your revenue numbers, your annual cost of sales. These blue cells populate from the previous spreadsheet. We tuck in a number that we want to average. So if, maybe you only have 3 years, maybe your business has only been in business for 3 or 4 years, we assign, and this gets us to an average, a multiple year average that we then use and assign a multiplier. And I think my next slide is the multiplier. Will we get to these? You will absolutely get these templates. Yep, I will share these templates with everybody. And then I probably should have asked, I don't know if everybody saw their profiles, but there's 2 years worth of P&Ls in there. And if you read through those profiles now, you'll start to understand what I'm talking about with, I say, the owner it's 4,000 but they run 200 a month in personal cell phones through. So you each, for those of you that have chose to adopt one of those profiles, you can. For others, we'll use whatever P&L you want to use. We'll get into this, but these are our loan amortization pages where they get populated from over here. And then we ultimately validate the validation, because as we talked about, we're going to talk about the debt service the cash flow that we can expect the business to generate for the new owner. We're going to have the different debt services. And what is the cash flow after all of that debt service, right? Is it enough? Does it make sense for the buyer? Alrighty, let's go back to, there we go. Okay. See, we have another question. Oh, so yep, thank you, Zach, for sharing that. All right, went to Excel. Alrighty. So often I will have business owners take a look and just start to look at their P&L and start to consider. So do it now, do it later, but take a look at your P&L and take a look at those suggestions and notes that I have, and start to think about how you'll make those adjustments and how you'll populate this spreadsheet. As I said, I will send the spreadsheet out, and you can do the entering the information into that first spreadsheet, and then we would probably work together as much or as little as you want to do the valuation. All right, so be realistic. You need to be able to document any of the adjustments that you're making. These spreadsheets do need to tie out to your taxes, and you really don't want to overstate your seller's discretionary earnings, because if that if it starts to compromise your trust with your potential buyers, that is not the right foot that you want to get off on. So we go through the exercise of, again, normalizing the earnings, and or recasting your earnings, that kind of thing. We come up with a seller's discretionary earnings of 55,000. We then need to apply, it's called an industry specific multiplier. And in this case, it's 1.5. And that gives us our goodwill evaluation of 82,500. I think my next slide up. So the multipliers are very industry specific. Like there's one for HVAC, there's one for specialty retail, there's one for plumbing, there's all this different stuff. And generally, the higher the risk, the lower the multiplier. And the multipliers have to do with levels of revenue and that kind of thing. But I think, yeah, here's just like the multipliers sometimes have a bearing on the level of seller's discretionary earnings as well. But here is an example of a valuation guide. So I owned a bike shop, so I was a ski, bike, and board shop, but here is a valuation guide. It gives some information about the size of the industry, a little description, growth statistics, and that kind of thing. But the meat is, these are these rule of thumb multipliers that we talk about. A way that we would calculate the value of the goodwill at the low end would be 20% times revenue. The high end is 30% times sales or revenue plus whatever you want to assign for inventory. I don't use EBIT and EBITDA because they're kind of complicated concepts. I really like this concept of seller's discretionary earnings because it's a concept we can wrap our heads around. So SDE is on the low end for a bike shop is 1.5 times SDE up to 2.5 times SDE. So just so we have some, I mentioned specialty retail, florist. Here are some examples of the range. 20 to 30% for bike shops, 15 to 20% of annual sales for a specialty retail, 30 to 35% for a florist. So you can see these multipliers are very specific to an industry. And then I think, yeah, so here's 1.5, 0.5, and then 2 to 3 times. And then for the florist, they don't even use SDE, which is kind of a curious concept to me, but it is what it is. So here's that kind of spreadsheet that I showed you where we came up with an average revenue, average seller's discretionary earnings. And we bring those numbers down so that 538 and change, and we assign those multipliers, 20% and 30%. So we have 107,000 at the low end, 161,000 at the high end. Similarly, if we bring that seller's discretionary earnings number down and we assign these high and low multipliers, 1.5 and 2.5, whoops, those are flip-flopped. Got to clean that up. Anyway, we end up with a really wide range on that goodwill valuation. And that's where we'll go through and we'll validate that valuation. Yeah, so that's a pretty wide range, right? And we'll go through and figure out a way to narrow down that range and assign a goodwill valuation.
Hey, Kim, a couple of questions. One,
okay.
Any idea of multipliers for professionals like accountants, lawyers, doctors, et cetera?
So I had a management consultant that I was speaking to earlier, and his was, I think it was 2 to 3 times SDE, and it was like, I'd have to look, but the multipliers are quite specific. Sorry, I don't know that one off the top of my head.
And Dan Keller, you asked a little while back and I missed it. Do you mean it has to match the taxes? Do you want to clarify what specifically you're asking for if your question wasn't answered?
Yeah, no, I thinking about it, it was probably more of a reaction. The idea that you have to, you've been running your business, some personal expenses through your business for years, and all of a sudden you're going to adjust that for taxes in your last year seems a little dangerous. It's really what I was thinking.
So,
right.
so You mean as you're getting ready to sell your business?
Yeah, I mean, if I'm an IRS agent, I'm sitting there, I'm saying, why is their cell phone bill going down 50% after 20 years of it being X? Probably people shouldn't have been running these expenses through their business to begin with, because you're adjusting it now, and if you would tie it to your taxes, it's pretty fishy.
So, yeah, I have a feeling that the adjustments are small enough that it would not raise a red flag.
Can I
But-
offer,
What's that?
can I offer that you don't have to change your tax reporting? This is a worksheet you and your team are preparing in the process of selling. You're going to file it away. You're going to share it with a potential buyer. You're not going to change your tax reporting. You're going to have a walk that reconciles the number that was on your tax return or your internal financial statements to what you used in the worksheet. You're not going to change your tax return.
So we're kind of, if it's in retrospect, you would absolutely go through this exercise. But if you're looking to sell 3 to 5 years down the line and you want to make your business look more profitable, you may want to actually consider running less of that through your business.
Agreed.
Because as I said, a lender is going to look at the P&Ls and they are not really going to care about these worksheets. And so Dan, I have not had an experience where it was significant enough that it raised red flags for the IRS. But suffice to say, the client that was running hundreds of dollars worth of Amazon expenses through their business probably shouldn't have been doing it in the first place, right? Because it is certainly gray, right? But that's not legit. Like that shouldn't be done. But like me running my gas through my business, if you were to take like I have a client that instead of doing all their gas and this, that, and the next thing, the CPA just put a giant adjustment at the end of the year onto their taxes, right? To increase because they assumed 55 cents a mile for X number of miles. But certainly we want to be above board to the extent that we can. I couldn't agree more. Any more, Zach?
No, and then I'll also flag and I think Danny just dropped something. As a partnership, our goal is to get folks to start 3 to 5 years in advance, and I think this really, really speaks to that. But I'll also flag that we're just coming up to time, so however we want to put a fork in it.
Yep. So
so much stuff.
Yeah, no, what's crazy is that was pretty much our end. What I would like to do, because we're not doing sell sheets, what I would like to do, if you would just grant me a tiny bit of, I am going to just ask really quickly. I'm going to launch, and if you have to go, I certainly get it. I'm going to launch this final poll that just kind of talks to some of the concepts that we've gone through. And if you wouldn't mind just kind of answering them, that would be great. We'll do it. It's just 5 questions.
And while you're doing that poll, Zach, do you want to just give a quick pitch about the upcoming networking event, or Kim about the upcoming networking event, and that they'll be receiving more stuff to start marketing that out to their constituents?
They've heard a lot from me, Zach. Why don't you jump in there?
Sure. Yeah, while you're doing this, and the veterans have heard even more about this. On February 15th, and I will send this information, we will host a matchmaking event for buyers and sellers, bringing together some established sellers in our network that are offering their businesses pretty publicly, that have been through a number of our processes. So it'll be a really tightly curated group. They'll be able to host virtual booths with tons of information. And we'll be asking folks we'll be asking all of y'all to really recruit entrepreneurs, potential buyers and other folks who might really like to talk to owners of established businesses. We'll send more information and profiles about the available businesses, but really looking for folks in your networks who may be ready to have some, they don't have to be like ready to buy tomorrow, but ready to start having some real conversations with current owners of established businesses about potential transitions. So it'll be a really exciting virtual free event on the 15th of February, and we'll get you lots of information about that.
Cool. Why don't we do like one more minute on the poll? For 30 seconds. We're doing pretty well. If I can get 2 more people to finish, I'll finish it. Three, 2, 1. Okay. So we'll go through these pretty quickly. Hopefully everybody can see. So the first person you should contact when you're getting ready is your accountant, right? That individual will help you in so many ways in terms of we're going to talk about a lot of concepts, but your asset allocation, your valuation, you're going to probably have questions as you go through your P&L, and they will just be a really important resource for you to have by your side. So good job there. You should include your attorney as much as possible in the process of selling your business, and it's 50-50. In my opinion, and I would say no. Attorneys want to get involved because they want to help you negotiate, and they want to earn their $300 an hour. In my opinion, you can negotiate the concepts of your deal, and you'll learn more and more about this as we go through. And then you turn it over to the attorney who draws up the legal documentation and maybe helps you answer certain key critical questions that are legal in nature, but they don't need to help you negotiate the value of your inventory, or how much you should pay for FF&E, or how long you should hold paper, or anything like that. So that's just my perspective on that. It's a best practice to market your business for sale openly and with full disclosure. And again, 50-50 on the result there. It depends very much on your business, and it is not necessarily a best practice. It is a way to get your business sold more quickly than not, but it could have negative effects on your business if you go to market and your employees learn that you're selling and they leave, or you have key customers that learn that you're selling and they leave. So it's a decision that you need to make very carefully about how you want to do that. 100%, yes, if anonymity is important, a broker is definitely to be considered. And sellers' discretionary earnings, most of you got the right answer. Again, it's kind of this concept of the cash that a business will generate for the new owner. So it is net profit, adding back those non-cash items such as depreciation, plus all of those owner's benefits that that an owner is running through their business. So most got that, and that's something that we'll continue to dig into, and we're good there. And I'm pretty sure our last slide, let me just see. Yeah, so yeah, our next session is going to be, hopefully you guys can see, because I can't see you. I don't know where you went. The 24th, February 24th, from 9 a.m. until 11 a.m. Obviously, we're going to go, we'll do a recap of this information, but we'll do work on sell sheets and marketing. I'm available as a resource, because one of the things that we do want you to do is establish a valuation for your business. And I will follow up with all of you on that, and we can set up a time to go through. And as I said, I can provide as much or as little assistance as you need. And Zach talked about our North Country Businesses for Sale, our virtual matchmaking event that we're really excited about, and we're hoping that you can help us market for. So thank you, everybody. I appreciate your being here. Hopefully you felt like the session was valuable. I certainly appreciate that this was in the weeds, and but it's good stuff, I think. And I look forward to working with each of you to help you kind of go further and understand how to do the seller's discretionary earnings calculation. I think we got a bunch of okay, this is all cool.
Thank
Thanks,
you so much, Kim, and thank you everybody else. And so next time we will start with more of a partnership meeting before we jump into the training. So you can look forward to that, getting to know each other a little bit better, learning about outreach in the region and what this looks like as a partnership. So thank you so much, Kim. Thank you so much, Zach. Thanks for everybody for being here, and look forward to seeing you next month.